Hello and welcome to the Financing a Sustainable Future podcast, brought to you by the Initiative in Sustainable Finance, funded by the Global School of Sustainability here at LSE. I'm Tom Gosling, Professor in Practice and Director of the Initiative. This is a podcast where we talk to LSE academics about their research on sustainable finance in a way that is accessible for practitioners. Today I'm delighted to be joined by Dimitri Vayanos, Professor of Finance at the London School of Economics, to talk about his recent paper, The Impact of Green Investors on Stock Prices, co-authored with Gosling, Eric Jondot and Benoit Maujean. Dimitri, welcome.
Thank you very much for inviting me.
Let's start with the motivation for the paper. So why look at the relationship between green investors and stock prices, and what gap in the literature were you seeking to fill?
Well, okay, there is this big debate on how investors can have an impact on companies' green policies. And there is this there are two main ways that have been discussed so far about how investors can impact companies. One is through divestment, and the other, essentially investors sell their shares in the companies, and the other is through engagement, that somehow investors can get a seat in the boards of these companies and have an active kind of influence on how these companies make decisions. So, and we focus on the first channel, the divestment, and we want to see how quantitatively important this channel can be.
So this is a theory paper, and I'm pleased it's a theory paper because I think practitioners often focus a lot on empirical papers. So maybe just before we start, what's the sort of distinctive contribution that a theory paper can make to this sort of question?
Absolutely, that's a very important question. And so how can theory be useful for this debate? So empiricists have measured for example, the difference in expected returns in average returns, let's say, between green firms and brown firms. And there is a range of estimates in the literature, some smaller and some larger. Now, theory can help pinpoint to this different mechanisms that are driving these effects. So, just to give two examples. Maybe the difference in expected returns between green firms and brown firms, maybe the fact that brown firms have higher average returns than green firms, might be driven to the fact that there are different risk characteristics. For example, brown firms have a greater sensitivity to climate shocks. For example, if there are some bad news about climate change, then brown firms, their stocks are going to go down more than green firms. So it's just a risk effect. And it's not about that green investors, just by selling brown firms, they cause the price of brown firms to go down. So there are very different mechanisms.
Yeah.
Another mechanism, just to add more kind of interest to the mix, is that maybe green firms have been doing well and therefore have had high returns. This some people have found, just because green investors have been piling in them. So we're trying to tease out these different mechanisms, and this is where theory can add value.
Fantastic. And so let's come on to discuss the theoretical setup. So your model distinguishes three types of investors, green, passive and active. Could you just explain the role of these and how they interact in your model?
Absolutely. So active investors, let's start with them. They are the more standard investors in finance models. These investors are essentially, they maximize a risk-return trade-off. They want to have high expected returns, and they're concerned about also variance. Green investors, they also care about risk and return, but they want to avoid some stocks, the most polluting stocks. So the way we model this in the paper is we are saying that they are tracking an index which excludes brown firms, the brownest firms. And we are assuming that the index that they are tracking actually excludes these brownest firms progressively. So they start with the most brown firms, and then they go to the least ones, and then keep doing that until they exclude about 10% of the market.
Right.
So this is this gradual exclusion is also a feature of the paper. There are some reasons why these indices, there's some rationale for the design of these indices. Anyway, so these green investors are doing that. And passive investors just track a broad market index. So these are the three types of investors.
Right, okay. And so how do they interact within the model then? How did, what happens when the green investors do their thing, the active investors, how do they react?
So what happens is that green investors, initially, they exclude, as I said before, 1% of the most polluting firms. Mm-hmm. Then, in the first year. Now, excluding means what? They are selling them, they make their portfolio weight on these firms equal to 0. The passive investors are not going to buy these firms because they hold their portfolio with market weights. Right. So they keep market weights, kind of the relative weights of their portfolios kind of constant. Active investors are going to buy these firms that green investors are selling. And so active investors, at the end of the first year in our model, are going to have a higher portfolio allocation into the brownest firms.
And in effect, they're forced to buy them, aren't they?
They're forced to buy them. Of course, they are still rational optimizing investors, so they are going to buy them, provided that their expected returns are going to go up. Right. So they have to be induced by a price change or a change in expected returns to buy them. And then second year, the green investors sell the next second kind of 1% of the brownest, the next brown firms, etc., until year 10. And then this process stops.
Okay, got it. And so actually what you've described here is actually directly relevant to the Paris-aligned benchmarks that have become quite prominent over the last few years. So there are investors really investing in line with these sorts of strategies. So when you look at your model, could you just describe the central calibrations? So what sort of proportions of different types of investors do you use and how did you come up with that?
Okay, so yes, so the calibration is important for that. We are looking at percentages of green investors between 5 and 15. Mm-hmm. Paris-aligned investors are smaller percentages than 5. But we are viewing the green investors in our model as a group of all green investors that exist. Mm-hmm. And then kind of percentage between 5 and 15 are reasonable. Yeah. Now, especially for Europe, the active versus passive, in other words, the remaining investors in the market, this is where things can get a bit tricky because right now, for example, if we look at mutual funds, let's say in the US equity market, about 60% of the money is invested into passive. Mm-hmm. So this has been a huge rise in passive over the past 30 years. Passive was about 3% of the market in the mid-90s. It overtook active in about 3-4 years ago. Now it's about 60% of passive plus active combined. Moreover, there are many active investors who, even though they are active, they behave a bit like passive. In other words, they have tracking error. Right. They cannot deviate too much from their benchmarks. Mm. So for the purpose of our model, they might not get completely out of their way to load up on brown stocks. So therefore, the 60% might be an underestimate in some way. And for that reason, we look at the percentages of the fraction of passive between 50 and 90 percent. And as I would say maybe a bit later, the 90 may seem high for the passive as a fraction of active and passive, but if we look at actual elasticities of demand, in other words, how much, let's say, what's the price impact of flows in the market, the more passive we have, the bigger price impact will be of flows. Flows will have bigger price impact because passives don't really buy them. It's actives who really provide the elasticity. If we look at this kind of various empirical estimates for the elasticities, there does not seem to be very high elasticity. So this 90% is not a bad estimate. So I can give you now a range. If we have 5% in the one side of the range, if we have 5% of greens and active and passive are 50% of passive plus active, we get small effects. Mm-hmm. We get an effect of the green investors, of these 5% green investors on the cost of capital of a couple of basis points. Right. If we have at the other extreme, we have 15% of greens and the passives are 90% of the remainder of passive plus active, we get about 30 basis points. So it makes a difference.
So it's a key assumption, and I can sort of understand your point about expanding the passive percentage because this concept of closet tracking is a well-known concept, isn't it? So you've just touched on the cost of capital impacts. What about the share price impacts over the 10 years?
The share price, yes. So when we get on the lower end of the effect, when we get a couple of basis points, the share price is also maybe about 0.3% or something below 1%. When we get on the higher side, when we get the cost of capital effect of about 30 basis points, the effect on the price is about 10%.
Right. Right. Okay. So we've got at the top end, we've got noticeable effects going on here. We'll maybe come back later to sort of how big these effects are. But first of all, you also identify a first mover advantage for firms because of the way the price dynamics develop. Can you just explain how that works and the intuition for that?
Yes. The first mover effect arises because of this gradual exclusion of because as I said before, this green index, we're assuming that some firms are excluded first, some firms are excluded in next, and this process goes for let's say 10 years in our calibration. So now, if an investor is one of the first to become green, then they will get a better return than becomes green later on, because they are earning a return because of these future flows. In other words, let's say that I sell the firms that are going to be excluded. I sell them today. The firms that are going to be excluded in after, let's say, 5 years. Then I anticipate the flows by these future green investors or whatever it comes into the index, and therefore I have a higher return. Essentially, I avoid getting a lower return.
Right, okay. And is there then also correspondingly an incentive for firms to shift their business models green earlier? Does that also apply?
Yes. It's a very interesting point that we are not addressing fully in the paper, because we don't look at. I think this would be really the next step in this research. We are not looking at the feedback effect from stock prices to firms' investment policies. And the fact that the cost of capital of brown firms goes up, or that if firms know that if they're going to be the worst in class, let's say, they are going to be kind of the worst of the remaining firms in that index, they're going to be excluded in the next few years. This might provide some incentive for them to invest and avoid this being excluded. So I guess there are two things. One is the incentive effect, and the other effect is that the firms that have the green firms have a lower cost of capital, so they can invest more. So both of these effects might, in fact, amplify whatever we find these effects that we find in the cost of capital in our model, where we take investment policies as exogenous.
So there's been quite a debate about the impact of exclusion strategies, and I think a lot of our listeners will be familiar with what's become quite a high-profile paper by Jonathan Burke and Jules van Binsbergen that analysed a similar problem and concluded that there were negligible effects of exclusion strategies on cost of capital. So how do we reconcile their finding with your finding? What's driving the difference?
Okay, I think the main reason why there's a difference is because we're assuming that a significant fraction of the market are these passive investors. So in other words, the paper by Burke and van Binsbergen assumes that investors are either green or active. And so they also assume a fairly small fraction of greens, but this does not make a difference whether it's 2% or 5% of greens or even 10%. The thing is that everybody who is not green, whenever greens are selling the brown companies, there is this massive set of active investors who are buying them. And what we're saying is, hold on a bit. Many investors many funds are passive, and they don't have such an elastic demand to buy these brown firms. And we believe that this is a realistic description of the market, because this kind of accords quite a bit with empirical evidence in other parts of our field these days, that the elasticity of demand for the aggregate stock market is fairly small. In other words, that flows in and out of the market can have a big effect on prices, both at the level of individual stocks and at the level of the aggregate market. And so the elasticity that this paper that Berger and van Binsbergen find is very high relative to the empirical estimates.
Right.
In general, this I'm not talking about green versus brown. I'm talking in general about estimates of elasticity.
Right.
First of all, it's realistic that they're passive. They are passive. We know passive funds have become very big anyway, and plus the kind of elasticity that is implied by the existence of passive funds and kind of having fairly low elasticity is a reasonable assumption. Now, we don't find this huge effect of green. We're going to come to that, I guess.
Yeah.
But still is an order of magnitude bigger
but it's still
than
material. Material and noticeable. So just to kind of just check my understanding of this then. So, I mean, a key driver of your mechanism is that these green investors sell out, so other investors have to buy more of those brown stocks. To be compensated for that overexposure, they want higher returns, so the price has to drop for them to buy them. Now, in the Burke and van Binsbergen paper, because there isn't this group of passive investors, that sort of extra holding of brown stocks is spread out amongst a large number of actives. Whereas in your paper, because you've got this big passive chunk in the middle, that overexposure to brown stocks is kind of concentrated in a smaller segment of the market. So there's a bigger effect. Is that roughly what's going on?
That's
here?
a beautiful way to state that.
Okay, great. I understood it. That's fantastic. Great. So let's come back to the magnitude of impact. So as you say, you find a magnitude of impact that's an order of magnitude bigger than the Van Binsbergen effect. And it's up to around 40 basis points. So that's obviously sort of noticeable. But there was some other kind of interesting analysis to think about, actually, how big is this really? And, Pedersen's got his paper on carbon pricing versus green finance, where he would suggest that actually for a brown firm, a cost of equity impact of 40 basis points is actually less than $10 per tonne carbon tax equivalent. So, how much in practice should we expect these green investing approaches to achieve?
Yeah, I think that's a good question. In some sense, we show that there is an effect. It's not. We agree with you that it's not a huge effect. It's decent, but it's not huge. So, as we said earlier, we have not looked at the implications for investment and kind of how this can really affect the corporation's investment policy. This change in these tens of 30, 40 basis points. But I'm not surprised that a carbon tax can be a more effective tool than even divestment by a significant fraction of the market.
Yeah, we shouldn't be surprised by the fairly obvious conclusion, should we? So, Dimitri, thanks. That was a really fascinating discussion, and I think your model provides a really helpful and rigorous perspective on how green preferences might translate into capital market impacts, which is extremely topical. So thank you very much.
Thanks very much, Tom.
You've been listening to the Financing a Sustainable Future podcast with me, Tom Gosling. If you enjoyed the conversation, please like, share and subscribe on your favourite platform. To find out more about the work of the Initiative in Sustainable Finance, which is funded by the Global School of Sustainability here at LSE, please go to fmg.ac.uk/ISF.